Most people in Ireland are familiar with the principal private property relief that you can use as an exemption against capital gains tax if you ever sell your main residence. What I want to focus on in this video are the main restrictions and rules on this relief. If you ever want to sell your home in the future, you need to be aware of these and plan for it so you are able to avail of this exemption. So under the PPR relief, you will be completely exempt from capital gains tax on a property that you own once you've lived in it as your main residence and also you've used the entire property as your home. This exemption will also cover up to 0.405 hectares that actually surround the property as well. Now I want to talk about 3 restrictions that apply to this rule that you need to be aware of. The first one is if you use any of your home to run your business. So let's say for an example that you use 50% of your home for your own personal use and 50% for business use. In that case, you will only be able to claim 50% of the relief on the capital gains tax. So let's have a look at a specific example for this that is on the revenue website. So Barry bought a property in 2004 for 480,000 and he sold it in 2018 for 580,000. So he made 100,000 profit. But he used 20% of his home to run his business for the entire time that he owned it. So that would mean that he will have to pay capital gains tax on that 20% of the profit that he made on the sale. So let's have a look at the specific calculation here. So as you can see here, he sold it for 580,000 on a cost of 480. That's a profit of 100,000. And then you have to take away the personal element, which he gets for the PPR relief. So 80% of his house was used for personal use. So he took away 80% of that chargeable gain. So that left 20,000, and then you also get a personal tax exemption against capital gains tax every year of €1,270. So that reduces taxable gain now to 18,730, and then the capital gains tax due on that at 33% then was 6,180. So the second restriction that applies to the PPR relief is related to absences. So this relates to time where you didn't use the property as your main residence. So one important thing to know here, even if you didn't use the property as your main residence for the 12 months previous to when you sold it, you'll still be considered that you lived there for the last 12 months. This rule is there to take account of time and issues of people moving into their new house and not having completely sold their old house. Outside of that then, you can only claim PPR relief for the time that you actually used your house as your main residence. But there are certain exceptions to this. So for instance, if your employer has made you go and work someplace that is far away from your home, that would be considered that you're still living in the house, and this exception only applies for a maximum of about 4 years. Another exception is, say, if your house was unoccupied and you were in hospital or you were in a retirement home, this would be also considered that you are still using the house as your main residence. So anything other than this, basically if you haven't used your house as your main residence, you have to time a portion, the time that you have used it and the time you haven't used it, and you can take that percentage of the PPR. And finally, the third restriction that applies to PPR relief relates to development value. So you'll only be able to claim the PPR relief on the value of the actual house itself and the land, and not the development value. Say for instance, if you sold your house and it was knocked and you put a big apartment block on it, you will only be able to claim PPR relief on the value that your house was worth and the land surrounding. So that's pretty much it for the video. If you have any questions, make sure to drop a comment, and I hope you enjoyed it, and make sure to like and subscribe to the channel.